Spreads can be one of the best ways to trade options, but they can be extremely difficult to enter and exit. So in this video, I'm going to teach you everything you need to know to enter and exit spreads like a champion trader. Stay tuned. So here's the truth, traders. You won't find any better option trader on YouTube, so make sure you subscribe because I'm giving you the best content ever. In this video, we're talking about spreads and just a couple reasons why we're using spreads and why traders use spreads is because when you buy something and sell it at the same time, which is theoretically what a spread is, you're limiting the risk. You're limiting the upside and the downside, which is good for beginning traders. I use spreads to lock in profits. I have a bunch of videos on that to show you that tactic. But what spreads do is allow you to profit from the time decay of the option or the volatility decrease. You can also buy options that are super expensive like Tesla and Amazon, and with spreads, you don't have to pay that much to get into a trade. So it allows you to pay less to get into a trade that you like. With spreads, you can play puts and be bearish or bullish. You can play calls and be bearish and bullish. I have 4 spread videos on my channel. You can check those out. I'll link those to the top right for you. But we're going to get into spreads, how to enter them, and how to exit them on Robinhood right now. Before we get started, I'd love to give you my free option trading course link in the bio. Options are tough, guys. I just really want to help you get started because I bring in income with it. As you see, this is my small account. Started with $250. Now we're sitting at $370, all using options. So where else can you take 200 bucks, turn it into almost 400 bucks in a matter of 10 days? So right here, I'm trading my target calls with my trading group. If you want 7 days for free, link below. But check this out. We're up about 60% in these calls, and these target calls, I locked in profit using a selling strategy with options. So as you see right now, I am long the 97 call. What I did to lock in profit is something I teach my traders to do. You have to click the View All Options button. With this button, we're not going to sell our option because that's going to cost us a day trade. What we're going to do is we're going to sell an option above our strike price if we're using calls. Opposite if you're using puts. So what that looks like is you click Sell and you have calls, and instead of, we have this 97s right here, as you see the +2, we have 2 contracts of those. We're profiting, we're up 90, 100%. I wanted to lock in that money, so what did I do? I didn't sell those and waste 2 day trades. I ended up selling 2 calls above it. Crazy, right? Didn't waste any day trades, and I can lock in some of that profit for tomorrow. So if the market gaps down, I'm still going to have some winning amount in this trade. So I sold the 98.5 calls, and let's go to the main screen. So again, this is what we call a ghetto spread, is where you put in the spread in a matter of different time periods. So you bought the calls in the morning, you sold the calls in the afternoon. So that's different time periods. I'm going to teach you how to do it in the same time period, but I also want to explain to you this whole strategy. As you can see right here, the calls I sold are right here in my account. So they're separate from the long calls. And if I scroll down, you can see that I'm up 28 bucks. So I sold these calls around $280 for a credit. So that went into my account. And right now, this is down about $20 from there. So theoretically, I could make the full amount if it trades sideways, drops. Basically, we want this to go to 0 so I can collect the full $218. So $218 went into my account to protect my initial investment, and I'm going to show you how much I put into this trade. So for these target calls, we're looking at about $194 for my initial investment. So if we do the math, I put in $194 and I sold $218. So if you're doing the math, the least I can make in this trade is $24. So the worst I could ever do in this trade is make $24. Isn't that crazy? So that's just because I sold those calls and they were worth more than my initial investment to get in this trade. So I did get into this trade with a lot of money, obviously, but I did scale into it. So as it was winning, I bought one more call. And that's why I have more of a position than usual. But again, we locked in profit by selling this call. So now that we have a short call and a long call, tomorrow morning I'm probably going to wake up and sell this so I can get out of my position. So this is what I would do in the morning. So for target, I would click the View All Options. And for me to get out of this spread that I've created for myself, this crazy spread, I will have to do the opposite of how I got into those spread trades or into the long and short calls. So I had 2 pluses for the 97s. We want to sell 2 of those, and then we want to buy 2 of the 98.5s. A lot of people are going to ask, hey, can I just, sell the short one and just keep the long one on? Or can I sell the long one, keep the short one on? And Robinhood really doesn't let you do that, unfortunately. They don't want you to be long exposed or short exposed. I think you need to close them at the same exact time, because you can't have -2 contracts for a target, because that limits you to crazy amounts of risk. You can lose infinity amounts of money doing that. So here, this is exactly what I'd do. I would buy the ones that say negative, and then I would sell the ones that say +2. And boom, there I am. This is a 2 option order, and I click continue. And what I want to do is I want to put 2 in, because I have 2 contracts of this, and that's going to close this whole trade for me. So what this does is it's actually going to put money into my account. It's going to give me a minimum credit of $132. So right now, my account from this trade already has money in it. It has about $215. And I was going to show you that, but it's not showing up on the main screen. So it's going to give me another $130. So in total, I'm going to have $330 in my account. But again, let's try that one more time. We're going to buy the ones that say negative and click sell the ones that say positive. And then we should have our trade right here. And then boom, we click continue. We click our contracts, and we got to enter them within the range. And it's very hard to get filled with spreads, unfortunately. Sometimes it's just not traders within the spread. So you might have to go really small. You might have to go really large, try to get filled at the highest or lowest parts. This is what I hate about spreads, honestly. Just there's not many traders trading spreads, and this is not very liquid. So you're going to lose. If you're looking at this difference between this is about, I would say, 30-40% within the spread right there of the bid-ask price. So the bid-ask spread is a 30% difference. So you could lose or make 30% just depending on where you get in and out. So that's exiting the spread. Let's say I just want to enter a spread just straight up. So we didn't really go over that today. Let's just pick a whole nother stock. Let's check out Disney. I'm going to show you the 4 spread options right now, how to get in and out of those. But first, let's just type it in and see how we input all of those together. So number 1, if we're bearish about this stock, this is what you do. You're going to do a call credit spread. And all that means is you're going to sell your first call. And that's going to be at a strike price, usually out of the money, because you don't want it to go in the money. It could get exercised. So we would be selling a call probably around here. And for this to be bearish, we want to buy a call above that. And the cool thing is once you click enter, it's going to say call credit spread. So you're going to feel like a wizard when you enter it correctly, and it tells you that you have that confirmation. And as you can see, this is a bearish play because we're getting money in our account and it's with calls. So we're expecting a drop in the market. So the best we can do in this trade is if it drops, we collect the full $27 in our account. Boom, $27. And the cool thing is the most you're going to risk is 100. Or yeah, 100, because it's the difference of strike prices. 101 minus 102, $100. So, you're making 30, you're trying to lose, you could lose 100 minus credit. So that's going to be $60. So 2 to 1, very good risk to reward. So the difference between the strike prices minus the credit going into your account. That's how you calculate it. Now, if I'm bullish on Disney, I could do a call debit spread. And this is how you input it. You click the one you want to buy first, and then you sell the one above that. So we sell the one above it. The cool thing about this is it lowers the amount we have to pay to get into the trade. So if I'm bullish on Disney, instead of paying that $85 I had, this cost of $85, I can lower the amount I want to pay by selling a call higher. If I don't think it's going to hit the strike price, I can sell it, and it just lowers the amount in the trade, but also lowers the amount I can make. Instead of making possibly infinity, I can only make 100, which is the difference of the strike prices minus the cost. So, you're trying to make $100, you're only risking 30. So the max you're risking in this trade is 30. the most you can make is the difference. So 27 minus 100, which is about $70. So that's a call debit spread. That's when you're feeling bullish about the market. And if I click continue, this is how we just execute it. And as you can see, the spread's just super wide. So spreads are great for traders to make money from, but when you're entering and exiting them, you want to make sure you're finding ones that are pretty tight, pretty liquid. If you use the SPY, it's usually one of the better spreads to trade. So that's the call debit spread. Let's input the last two, which are puts, and that's going to be the put credit spread. So the put credit spread is going to be where you're bullish about the market and you don't want it to drop anymore. That's where you sell a put right away. So sell a put, like I said, out of money. We don't want to go in the money or else we get exercised. We want to buy a put lower than that because that's going to be our credit. And as you can see, put credit spread shows up on the screen and we collect $16 for this trade. So we collect the full 16 if this happens. If we close above the 96.5 strike price, which is the one we used here, if we close above that on Friday, which is the expiration date, we'll collect the full $16. You can close this spread tomorrow, the next day, but you won't collect the full 16 unless you let it close at the day of expiration. Just go straight to zero. And again, the most you're risking in this trade is the difference between the strike prices minus the credit. So it's going to be $50 minus 15, which is about $35. So you're trying to make $15 and you're risking about 30. So that's what we do when we're using a call put credit spread. We want to do now a put debit spread. So if you're feeling bearish about the market, this is how you enter it. We want to go buy for our first put, and then we want to sell one underneath that because that's going to lower the amount getting in the trade. It's going to cost less to be a part of this whatever directional moves happening, as well as limit the downside and upside. So the most we can make in this trade is 100 difference between the strike prices minus 33, which is $70. So we're risking 30, we're trying to make 70. Again, 1 to 2, 2 to 1 risk to reward ratio. So same as what we've been seeing in the market lately. So it's pretty exciting when you see these setups, but entering spreads can be also very confusing. So all you want to do is just find spreads that have a very tight bid-ask spread in the middle. If those are really, really wide, you're going to lose lots of money. This one is like 50% right here. So if you enter at the top and you exit at the bottom, you're losing 50%, and this might not have even gone in your direction. So it's very, very frustrating to trade spreads that are not liquid. And this is Disney. You'd think Disney spreads would be liquid. So let's check out one more spread. This is the SPY, and this one is just tough because this spread is just so volatile sometimes it's not. But let's see how liquid it is if we're going to do a call debit spread. So call debit spread, we're going to buy a put, buy a call, and then sell a call higher. And as you can see, we have a spread that is about, looks like $10 between the bid ask. That's going to be about 30-ish%. So 20-30%, a lot less than some of the ones we were seeing, but again, it's very wide. So that's the one downside of spread trading. But again, for beginning traders, it's really good to understand spreads, and it does limit your downside too. So it just helps you not risk that much and hopefully still be a part of the trade, make some money if it does go according to plan. But that's how we enter spreads. That's how we exit spreads. If I go to my main screen, as you can see, this small account is all options, some spreads, some not spreads, but we're doing all right. We're up $120 from our $250 starting place. So if you want to join us 7 days for free, link below. But in the meantime, check out this video where I'm going to tell you 3 ways to avoid day trades using spreads and options. Stay tuned. You're restricted from day trading. Placing this trade may result in another day trade and restrict you from buying stock for 90 days. Edit order or accept the 90-day buy restriction.